Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, we have Brian Joyce. We've been working together for 5 years. Managing director at Nasdaq's Market Intelligence Desk. And I'm just a little bit excited to talk to you, Brian, to get some technicals in the Nasdaq 100.
Sure.
Finally, Powell's comments tomorrow to Jackson Hole. I feel like the market's been in somewhat of a holding pattern, which is interesting because they've been pretty clear with telegraphing their message.
Yeah, I guess they've been clear on that. Though they did change it a little bit last meeting when they said we're now going to become more data dependent. So I think before that, obviously they were way behind the curve when rates, I should say, inflation's been going higher really since late 2020. So now that they've ramped it up quite a bit, they're up to around 2.5 on the overnight rate. It's considered to be the normalized level in a normal environment. We're certainly not in a normal environment right now, so they will go above that. But they could raise it 50 instead of the 75 bips we saw the last 2 times. So what will they say tomorrow? I think what the market is expecting is a more hawkish tone tomorrow because of the relief rally we've seen since mid-June.
And let's talk about that with some fresh technical levels to watch on the Nasdaq 100, because I'm sure the question that you're getting in, was June the lows? Do we have more chop through the end of the year? We have, seasonally, September and October tend to be a little bit more volatile. We have midterms in November.
Yep.
So I guess the question is, was June the low? Is there more chop, or how does it look?
Yeah, interestingly enough, a lot of the strategists I read and follow, especially the market technicians, I should say, they've really become a lot more optimistic, a lot more constructive with the market. The 2 popular metrics is the S&P 500, the 50% retrace that it's reached off the lows, and if you look back historically, that after all major lows in cyclical bottoms, bear market lows, once a 50% retrace has been reached, that has almost all the time has marked the low. The low was already in. So, and then the other metric is the percentage of stocks above the 50-day moving average, which all the major indices, U.S. equity indices, have reached over 90%. That's another popular metric to signal that the market low has already been in. So we'll see this time. People say this time is it's never different. So history always repeats. It's not different if you compare it back to the pre-inflationary eras, but it's certainly different from the last 40 years when we haven't really seen inflation. So
yeah, well, I mean, look, we had 13 years of so much liquidity injected into the market. We were artificially keeping rates low, and then now this is a prolonged market environment where there is volatility, and we didn't have those normal natural cycles because they weren't allowed to happen. So to your point, it does feel a little bit different. But let's take a look at your first chart here, the Nasdaq 100.
So we're looking at a short-term chart of the Nasdaq 100. It's rallied 25% off the lows to the recent highs. We had a gap lower. Well, we had weakness on Friday, and then we gap lower this week on Monday. So you have a gap in the chart at 13,210. I think that right there is your overhead resistance in the very near term that bulls would want to see the price get back above, and then support is down at 12,840. So those are the 2 key short-term levels I would be looking at for the Nasdaq 100.
And another story, and I think we're waiting for some reaction out of Jackson Hole tomorrow as well, what's happening with the dollar, because that really has been a key narrative.
Yeah, so the dollar made its initial year-to-date high in July. It then pulled back, which coincided with the rally in equities.
Right, which is interesting. You would think it would be a little bit counterintuitive for that to happen.
Yeah, so there's been that inverse correlation as we've seen this year, the stronger dollar. To be honest with you, if Bloomberg goes back about 54 years with the DXY index, and this is the 3rd biggest year in the dollar in 54 years, and the 2 other prior records were 81 and 84, and those were just 1 or 2 percentage points above what we've already done this year. So we have plenty of time left in the year. If we do have a more hawkish Fed and another risk-off environment going forward into the latter half of this year, I think you could easily see the dollar have a record year. So that would be somewhat concerning. The recent high, so the dollar peaked in July, it pulled back and then rebounded, and this week hit that July high. So some people out there are saying, maybe this is the top in the dollar and now it'll start pulling back. But if you look at the euro-US dollar pair, that makes almost 60% of the DXY index. This is a longer-term monthly period chart. You can see last month in July, it broke a 7-year support level around 104, 105, and it was down for the month of July, down again in August. So if that continues to trend lower, and we certainly know Europe has quite a bit of problems, I think you could potentially see that DXY index, which moves inversely to what this euro-dollar currency pair moves. I think that you could see new highs in the dollar, and maybe we'll reach the all-time gains this year.
Yeah, it's going to be challenging for the international conglomerates, that's for sure.
Yes.
Let's wrap up with the 10-year. Of course, rates are super sensitive to what's happening with the macro environment.
Yeah, so the 10-year, strong uptrend in rates this year, and then on the pullback off the highs, we've seen 270 act as that key support level. It's been holding that support, and now the most recent rebound in rates is kind of topping out here around 310, 312, 3.12%. That was a top in April, and it was a top last month in July. So I'd call that an intermediate resistance level. We are turning lower today. It's coinciding with what's going on in commodities. The WTI oil has had a nice run higher in the last week or two, and it seemed to break out of a declining price channel, but it ran into that 200-day moving average. So I think commodities and rates right here at an inflection point. Maybe tomorrow Jackson Hole will be the next driver.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.